You know that good feeling when you open your wallet and find a bill you didn't even remember you had? That's pretty much what happens when you invest in stocks or funds that pay out dividends, which is like a company saying, "Here's a little piece of our profit. Thanks for investing in us." Now imagine this happening every month or every 3 months, like an extra salary dropping into your account. It's much cooler than just checking whether the stock price has gone up or down, like someone watching the oven waiting for the cake to rise. When I started seeing this money dripping into my account, something changed. It motivated me. It made me want to invest more, save more. Every time I saw these deposits, it was as if my money was working for me without me having to do anything. And the best part, this type of investment doesn't depend on whether the market is rising or falling. The stock price may fall, but if the dividend keeps coming, everything's fine. It's a feeling of stability, like knowing the post office will deliver your letter even in the rain. Think about it. If you had a tree in your backyard that bore fruit all year round, would you rather pick the fruit and let it grow, or cut the branches every time you felt hungry? That's more or less the difference between investing for income, dividends, and investing just to sell when you need money. Many people save money in a fund or in stocks, hoping they appreciate and then sell them. It works. But there's a problem. What if the market crashes? What if the stock price plummets just when you need the money most? Then you'll have to sell more shares than I would like, just to pay your bills. With dividends, it's different. You can live off the harvest. That is, payments that fall every month or every quarter without having to sell the shares. They remain there, firm like a well-tended tree. And meanwhile, the money continues to drip into your account. During crises or market crashes, this brings enormous peace. It doesn't matter if the price drops 10% or 20%. If the dividends keep coming, I can continue living peacefully without rushing or panicking. It's like having an income that doesn't depend on the market's mood. And when you reach this stage, it feels like you've won the money game without having to leave the game. If you want to learn more about how to make real money with dividend-paying investments, subscribe to the channel so you don't miss any content. Knowing exactly when I can stop working, like counting the days until vacation. Have you ever tried to plan for retirement just by looking at how much money you have saved? Like, will I be able to live comfortably until the end of my life with $900,000? Hard, right? It's like guessing how many days a tank of gas will last without knowing how many miles you'll have left to drive. Now, imagine this. You know you need $3,000 per month to live comfortably, and then you start investing in stocks and funds that pay dividends. One day you look at your account and see that you're already receiving $1,000 per month dividends. Okay, it's clear. You are 1/3 of the way. Just fold this and you'll be there. That's what made me love this type of investment. It gives me a simple, concrete goal. It's not, I want to get rich. It's, I want to earn $3,000 a month just from my investments. It's like counting down the days until vacation. With each passing month, with each new dividend deposit, I know I'm closer to not having to work if I don't want to. When I invested only in index funds and growth stocks, everything seemed a bit hazy. Now I see every dividend as one step closer to freedom, having peace even when the market is a mess, like sleeping peacefully during a storm. You know that moment when everyone starts freaking out because the market has crashed? Headlines scream, "Crisis," prices plummet, and people rush to sell stocks as if the world were ending. Now, imagine that you are in the middle of this storm, but lying in your bed calm, listening to the rain hitting the roof, because you know that everything is okay. That's what happens when you invest for income. When everyone else is worried about stock prices, I'm looking at something else. Are dividends still being credited to my account? If so, then I go in peace. The price may even drop 10%, 15%, 20%. Of course, it's not nice to see that happen, but does not affect my pocket directly. It's as if the value of your property drops on paper, but the rent you receive each month remains the same. You stop caring so much about how much it's worth and start caring more about how much you pay. And the best part, if a good stock or fund gets cheaper, I can buy it. More shares for less money and still receive more dividends. It's like taking advantage of a sale to earn even more in the future. Meanwhile, those who thrive on growth often need to sell at a low price, and that's when despair sets in. With income, you gain something that few investors have: peace of mind, even when the market turns upside down. Enjoy receiving practical tips to increase your passive income? Then click the subscribe button and join me on this journey. Buy more when everything is cheap, like filling your cart during a sale. You know when there's a super sale at the market and you think, wow, I'll take advantage and get two instead of one. With income investments, that's exactly what happens when stock prices drop, but dividends remain firm. Look, when a dividend stock drops in price but continues to pay the same amount, it means you are receiving a higher return on every dollar invested. It's like before you invested $100 and earned $5 a year, and now you invest the same $100 and earn $6 or $7. For me, this is one of the greatest superpowers of this type of strategy. While others panic and sell, I get excited because I can buy more income with less money. Of course, I don't just go out and buy anything that drops in price. I always look at the fundamentals, see if the company or fund is still solid, if it has a stable payment history. But what if everything makes sense and the price is right? I'll go there and I take advantage of the promotion. And you know what that does to us psychologically? It takes away the fear. Instead of hoping the market will go up, I start hoping it will go down. Because I know I will accelerate my results, buying more income with every penny. It's literally turning market crises into opportunities. And this completely changes the way you relate to your money, protecting my future without relying on luck, like building a house with bricks, not playing cards. Think about it. When someone invests just to see the value grow and plans to sell the shares later, they are playing a risky game. It's like someone building a house of cards, and it might look pretty at first, but the slightest wind can blow it all down. Now, imagine another person who day after day puts firm bricks, applying cement, reinforcing the base. This person is building something that can withstand a storm. Investing to generate income with dividends is exactly that. You are building a system that works even when the market doesn't help. The problem with relying on stock appreciation when you bet everything on growth, e.g. tech stocks that don't pay dividends, you're saying, I'm going to sell these shares in 10, 20, 30 years and live off that money. But what if the market is down right now? You will be forced to sell more shares than I wanted for a lower price just to pay the bills. It's like selling part of your house to pay rent, and that could end up shortening your retirement or forcing you to go back to work. The advantage of income: money comes in without you selling anything. With dividends, you build a system where money goes into your account every month, whether the market rises or falls. You don't need to sell a single share. And the most interesting part, if you never sell your shares, your assets remain intact. This means that you can live in peace because you know that your income is stable. He can leave a legacy for your family with a portfolio still making money, and you can even continue reinvesting dividends and make your income grow even more over time. Short story: John and Charles. Imagine two friends, John and Charles. John invests only in growth stocks. He has $1 million, but he needs to sell little by little to survive. If the market drops, he despairs. Carlos, on the other hand, also has $1 million, but it's all invested in stocks and dividend-paying funds. He receives $4,000 per month without selling anything. Who do you think sleeps better at night? Exactly. Carlos built it with bricks. João bet on cards. That's the beauty of passive income. You take luck out of the equation and put it in strategy in place. Here on my channel, I share everything about investments that help you build a monthly income. Subscribe and stay tuned, knowing exactly where I am and where I'm going, like using a map with GPS, not a broken compass. When you invest thinking about dividend income, it's like using a GPS to plan your financial freedom. You set your destination, for example, earning $3,000 a month without having to work, and the system shows you exactly how far you need to go to get there. Now, if you invest just to accumulate money and sell later, it's like walking around with a broken compass. You might even be heading in the right direction, but you're never sure how much is left or if there will be time. With dividends, you see your progress month by month. For example, let's say you want to live on $3,000 a month. You log into your brokerage account and see that you are currently receiving $200 per month in dividends. Ready? No complications. You know that's 40% of the way there. This clarity is powerful. It removes anxiety and increases motivation. When I was putting my money solely into index funds, I asked myself, will this be enough in the future? How much will all this yield in 15 years? And the answers were never clear. Now I look at my statement and see this fund paid me $50 this month. That other one paid me $120. In total, I received $850. It's like putting together pieces of a puzzle and seeing the picture take shape. You turn a dream into a concrete goal. When you have a numerical goal, for example, $3,000 per month, everything becomes more tangible. You know how much do you need to invest in each stock or fund. He knows how much each new investment will yield. You know exactly how many steps are left to free yourself from work. And that, my friend, is much more exciting than simply saving money and hoping for the best. Investing for dividends means your money is always generating income, regardless of whether you're actively investing. Unlike investing solely based on stock price appreciation, where you need to constantly monitor the market to decide when to buy or sell, investing for dividends allows you to receive regular payments simply by holding your shares or funds. These payments, called dividends, function as a kind of passive income that automatically and periodically enters your bank account, usually monthly or quarterly. This means your capital is always working for you, producing financial returns even while you're engaged in other activities or even relaxing. Furthermore, this type of investment offers greater peace of mind and security, as you don't have to worry about daily market fluctuations to generate income. While stock prices can fluctuate significantly, dividend income tends to be more stable, especially in established companies or funds focused on regular payments. Another important point is that this passive income can be reinvested, allowing your portfolio to grow and increasing the value of future dividends, creating a compounding effect that maximizes your earnings over time. Ultimately, this strategy helps you build stronger financial independence because you don't have to rely on asset sales to raise cash. This reduces the risk of needing to liquidate investments in unfavorable times, protecting your assets and ensuring a continuous source of income. When you invest seeking income through dividends, one of the most important strategies is diversify your investments. This means not putting all your money into a single type of stock, sector, or fund, but rather spreading your capital across several different types of investments. The main reason to diversify is to reduce risk. Imagine you invest everything in a single company or sector, and that company experiences financial difficulties or has to cut dividends. In this scenario, your passive income could decrease or even disappear, which could affect your financial stability. Therefore, when building a diversified portfolio, you include different types of investments such as stocks of solid, dividend-paying companies, which tend to be more stable, real estate investment trusts, REITs, which pay monthly income based on property rentals, closed-end funds, which can pay high dividends and have varied strategies, business development companies, BDCs, which invest in smaller businesses and distribute a large portion of the profits to shareholders, funds that use options strategies such as covered calls, which generate extra income for investors. This variety helps protect your money because different sectors and types of investments intend to react differently to economic changes. For example, while the real estate sector may be struggling, an energy company or a fund with different strategies may continue to generate good dividends. Furthermore, it is important to include in the portfolio some investments focused on capital growth to help protect against inflation. This is essential because, over time, inflation reduces the purchasing power of money, meaning what you can buy with $100 today may be less in a few years. Growing investments can increase the value of dividends paid and consequently maintain your standard of living. Diversification also helps maintain a more stable income, which is essential for those who rely on these dividends to cover daily expenses. Having different sources of passive income ensures that even if one investment suffers a cut, your portfolio as a whole continues to generate sufficient income. Therefore, thinking about diversification isn't just about spreading risk, but rather creating a safety net for your income and assets, increasing your chances of having a peaceful and sustainable financial life in the long term. Investing with a focus on dividends has a major practical advantage. It makes it much easier to track your progress toward retirement. When you know how much money is regularly flowing into your account through dividends, you can concretely measure how much you've already earned to live off passive income. That is, without relying on a job. For example, if you need $3,000 per month to cover your basic expenses, simply track the total dividends you receive each month. If you receive $1,000 today, you already know you're 1/3 of the way to reaching your goal. This makes the goal very clear and tangible. This method differs from traditional investing, which focuses solely on stock appreciation, where the value of your portfolio can fluctuate significantly as the market rises and falls. Thus, you may have a large balance in your investment account, but no clear idea of how much you can safely and steadily spend each month. This uncertainty can make retirement planning difficult, as you don't know if the accumulated value will be enough to live on. Additionally, tracking your dividends regularly helps maintain motivation. Seeing your passive income grow over time makes you feel more confident and engaged to continue saving and investing. This sense of constant progress is crucial for maintaining financial discipline and achieving independence. Ultimately, this clarity in planning allows you to make more precise adjustments to your finances, such as increasing your investment amount, reducing expenses, or diversifying your investments to accelerate your goal. All this with less anxiety and greater security because your path to retirement is clearly mapped out by your actual passive income, not just hypothetical stock appreciation figures. When you invest in dividend-paying stocks, you begin to receive a steady passive income, usually monthly or quarterly. This money flowing regularly into your account creates a very positive and concrete feeling that your investments are truly working for you. This frequent return helps transform the act of investing into something much more tangible and rewarding. Unlike simply seeing the value of your shares rise or fall, receiving dividends is like receiving a reward for your investment. This makes you feel rewarded for your effort and dedication to saving and investing money. Furthermore, these dividends can be automatically reinvested to buy more shares, increasing the amount of dividends you receive next time. This process creates an exponential growth cycle known as compound interest, where the money you earn begins to generate even more money, accelerating your financial progress. This positive cycle also helps build financial discipline. Seeing dividends increase over time encourages you to continue investing, saving, and even seeking new income-generating investments. This transforms investing from something that may seem complicated or distant into a motivating and enjoyable activity. Finally, regular dividends also provide greater emotional security. In times of market instability, when stock prices may fall, knowing you'll still receive income helps reduce anxiety and fear, keeping you focused on the long term. When it comes to investing, there's no single formula that works for everyone. Everyone has different goals, risk tolerance, timeframes, and needs. Therefore, the most important thing is to choose a strategy that suits your profile, lifestyle, and dreams. Some people prefer to invest with the expectation of stock value growth over time, even if it means weathering significant market fluctuations. Others prefer to invest in stocks that pay dividends regularly to provide a steady source of passive income. Many even choose to combine both approaches to balance security with growth potential. It's crucial to understand that no strategy is perfect. Investing in high dividend stocks can mean facing greater tax risks or fluctuations in stock prices. Investing solely in growth can mean relying on market appreciation, which can be volatile and unpredictable. Therefore, understanding the pros and cons of each method helps you make more informed decisions. More important than following what everyone else does is finding a way to invest that you can maintain with discipline over the long term. Consistency is what truly brings results, because it's over time that your money grows, whether through appreciation or passive income. It's also essential to adjust your strategy as your life changes. What works for you today may not be ideal 10 or 20 years from now. Therefore, reviewing your portfolio regularly and adapting your plan is essential for financial success. In short, the best investment is the one that suits you, gives you the confidence to continue, and helps you achieve your financial goals in a sustainable and comfortable way.